Hey everyone, welcome back to Corporate Decoder, the place where we dive into the exciting world of corporate filings. Today we're cracking open a Form 8K from First United Corporation. And no, it's not about their latest branch opening, but something far more interesting. Executive perks. Prepare for a deep dive into the world of supplemental retirement plans and how top executives are setting themselves up for a comfortable future, all while potentially impacting the company's bottom line. Scrolls of report date of earliest event co-reporting. This report is dated March 27, 2025, which means we're getting a peek at something that happened around that time. This isn't their annual or quarterly financial report, which gives it a different flavour. A Form 8K is used to announce significant events, so let's find out what's worth reporting here. Scroll compensatory arrangement scroll. Here we go, the good stuff. This filing is all about changes to the retirement plans for two key executives, Carissa Rodeheaver, the Chairman, President and CEO, and Jason Rush, the Senior Vice President and Chief Operating Officer. It involves something called the First United Bank and Trust Defined Benefit Supplemental Executive Retirement Plan, or SUB. Think of it as a little something extra on top of their regular retirement benefits. Essentially, both executives are tweaking their existing agreements under this SERP. These agreements initially allowed them to choose how they'd receive their retirement benefits. Now, they're adding a specific clause dealing with lump sum payments, which is a one-time payout. Scroll distribution Tetu from a lump sum payment must scroll. The original agreement had some rules for changing how they wanted the money. If they wanted a lump sum instead of regular payments, there were conditions. The change had to be made at least a year before the original payment date, go into effect at least a year after the change, and delay the start of payments by at least 5 years. Think of it like saying, hey, I want all my money now, but with a 5-year waiting period. Here's the kicker. The amendment now adds interest on any postponed lump sum payments. So if they delay the lump sum, they get extra money. The interest is calculated using a rate tied to the Internal Revenue Code, specifically Section 417X, and it compounds annually. Compounding annually just means the interest is added to the principal, and the next interest calculation includes that previous interest. It's interest on interest, which can really add up over time. The way it works is that the initial lump sum amount is determined as if they were receiving the annuity or yearly payment on the original date. Then interest is added from that original date to the new postponed payment date. So it's like the money is sitting there growing even though they are not receiving it yet. The company also mentions their definitive proxy statement filed also on March 27, 2025, which includes information about executive compensation and the SERP. This is just extra information to keep in mind. The full details of the SERP are in their annual report, Form 10K from the previous year. Scroll form, kurzer scroll. Finally, we have the exhibits. Exhibit 10.1 is the actual form of the amendment to the participation agreement. If you really wanted to see the exact wording, you could look there, and Exhibit 104 is a computer file related to the filing format. So what's the big deal? Why should anyone care about this? Well, it highlights how executive compensation packages can be structured to incentivize certain behaviors, in this case potentially delaying payouts. By adding interest to postponed lump sums, the executives might be more inclined to delay their retirement benefits. This could benefit the company by retaining experienced leadership for a longer period. However, it also raises questions about fairness. Are these supplemental retirement plans overly generous? Do they create a disconnect between executive interests and shareholder interests? While these plans can attract and retain top talent, they also represent a significant expense. The money used for these benefits could potentially be used for other investments such as research and development, marketing, or even increasing dividends for shareholders. From a financial perspective, the impact of this particular amendment is probably limited. It only affects 2 executives, and the interest rate is tied to a standard benchmark. However, it's important to consider the cumulative effect of all executive compensation packages. These costs can add up and affect the company's overall profitability. From a Warren Buffett-style analysis perspective, this looks good, because the executives are incentivized to postpone their payments. This should make them think more like owners and less like employees, since they will have to wait to reap the reward. Looking at First United Corporation more broadly, the company appears to be in a stable position. However, like any financial institution, they face risks related to economic conditions, interest rate fluctuations, and regulatory changes. These executive compensation packages should ensure the company is taken care of. The risk is that shareholders' money is also being taken care of in a generous way to the executive level. In conclusion, this Form 8K gives us a glimpse into the world of executive compensation and the strategies companies use to attract and retain top talent. While this amendment might seem minor, it highlights the complexities and potential trade-offs involved in designing executive compensation packages. Thanks for watching. If you enjoyed this deep dive into corporate filings, please like, comment, and subscribe for more decoder breakdowns. Let us know what companies you want us to decode next.